All right, let's jump right in. We're going to be talking about what could be a massive breakthrough in finance. You see, for decades, the smartest folks on Wall Street have been chasing this holy grail, one single theory to explain how all stocks work. And it looks like someone might have finally cracked it.
So here's the big puzzle that's kept people up at night. Why is it that some stocks, what we call value stocks, the solid, maybe a little boring, but undervalued companies, behave one way, while momentum stocks, those tech darlings that are just soaring, seem to follow a totally different playbook? It's like they're playing different games on the same field. How do you explain that with just one set of rules?
Okay, so this is the first part of our story. We're setting up this massive puzzle that's been nagging at the heart of finance for a very long time. All right, let's meet the main character here, a model called the investment CAPM. Now, this thing was a huge deal. The idea was brilliant, really. It was supposed to be the bridge that connects a company's real-world actions, building a new factory, buying more trucks, directly to its stock price. It was meant to link the nuts and bolts of the economy to the numbers on Wall Street.
So, if the idea was so great, what went wrong? Well, that's where things get really interesting. It turns out this model had a pretty big flaw, a flaw that basically stopped it from being the one theory to rule them all.
And look, this wasn't just a tiny glitch. We're talking about a fundamental problem. Even a top economist like John Campbell called it out, saying this was a pervasive issue. The model basically forced you to cheat. You had to tweak the rules of the game depending on which type of stock you were looking at. And this really shows you what was going on. It's like the model had a split personality. To explain value stocks, you had to dial in one set of numbers. But then to explain momentum stocks, whoa, you had to completely change the settings. Look at the adjustment cost. That's basically how hard it is for a company to invest and grow. For momentum stocks, the model said that cost was way, way lower. A true theory shouldn't need you to change the laws of physics depending on what you're looking at, right? So at the end of the day, the model just wasn't a unified theory. You couldn't use one set of settings to explain the whole market. That analogy of the physicist is perfect. It's like saying gravity pulls on apples with one force, but on oranges with a totally different one. It doesn't work. It's not a real theory. Okay, so the old model was broken. So what's the fix? Well, the researchers who cracked this came up with two really powerful solutions. And the first one was all about the data. The way things used to be done was, frankly, a bit blurry. They take a whole bunch of similar companies, lump them into a big bucket, and then just average everything out. Imagine trying to paint a portrait of a crowd by just mixing all the colors together. You just get a muddy brown, right? You lose all the individual faces, all the important details. The new way, it's like going from that blurry, muddy painting to a super high-definition photograph. Instead of averaging first, they built the model for every single company, one by one. They kept all that unique, specific information. It's like taking a perfect photo of every single person in the crowd before you say anything about the crowd as a whole.
And that's the absolute key here. It's about the order you do things in. The old way, blur first, then analyze. The new way, analyze each crystal clear detail first, then zoom out to see the big picture. It sounds simple, but that one change in process, it was a complete game changer.
Okay, that was fix number one. But the second fix is just as crucial. And this one came from asking a really fundamental question. What actually makes a company productive? What is its capital? See, the old models were obsessed with physical stuff. Factories, machines, buildings. But when you actually look at the books of a typical company, all that physical stuff, it's only about 38% of what they use to make money. Think about that. The model was ignoring more than half of the picture. So where's the other 62%? It's something called working capital. And this is the real lifeblood of a business. It's the cash they need to make payroll, the inventory sitting in the warehouse waiting to be sold, the money customers still owe them. It's the grease that keeps the whole machine running day to day. And the old model, it just pretended it wasn't there. The fancy term for this idea is capital heterogeneity. Basically that not all capital is the same. And it's so important. Ignoring working capital, that's like trying to figure out how fast a Formula One car is by only looking at the engine block. You're completely ignoring the fuel, the tires, the aerodynamics, the driver. You're missing almost everything that actually makes it go.
So, there you have it. Two huge fixes. First, use high-def, company-by-company data. Second, account for all the capital, not just the physical stuff. So, the moment of truth. They put this new, supercharged model to the test. How did it do? Okay, so this is the before shot. This is the old model trying to predict stock returns. You've got what the model predicted on one axis and what really happened on the other. If it were perfect, all those dots would be on a nice, clean 45-degree line. But look at this. They're all over the map. It's basically just a random cloud. The model had almost no predictive power.
And now, the after. Wow, look at that. This is the payoff. With those two fixes, suddenly everything just clicks into place. The predicted returns versus the actual returns, they snap right onto that 45-degree line. It's clean, it's tight, it's beautiful. For the first time, for value stocks, momentum stocks, all of them, the theory actually lines up with what happens in the real world. Let's put some hard numbers on this. The old model had a huge error when trying to explain value stocks, what finance folks call alpha. It was off by almost 9%. That's a massive gap. The new model? It cuts that error down to just over 1%. That's not just an improvement, that's a revolutionary leap in accuracy.
So what's the big deal? Why should we care that a bunch of dots on a chart finally line up? What does this actually mean?
Well, here's what we've learned. It turns out this huge financial puzzle wasn't unsolvable. We were just using the wrong tools. The lesson is that details matter. How you handle your data, going from that blurry average to high-def individual firms, is everything. And the second lesson is that reality matters. Companies aren't just factories and machines. You have to include their working capital, their lifeblood. Put those two things together, and suddenly we're a whole lot closer to that ultimate goal, a single theory that explains why stocks do what they do. And that's what's so exciting. This isn't just about solving one old problem. It's about a whole new philosophy. It tells us that if we're willing to embrace the messy, high-definition reality of how companies actually work, well, what other big mysteries of the financial world could we solve next?